I've created this video to discuss a few concepts with respect to fixed assets and depreciation. First of all, depreciation represents a loss of usefulness. It does not represent a loss of value. It is not the opposite of appreciation. Depreciation represents a loss of usefulness. And to depreciate an asset, that means what we're going to do is take the cost of an asset and spread that cost out over the asset's useful life. So let's take a look at an example of that. If we have an asset that cost us $10,000 and it has a useful life of 5 years, if we're calculating straight line depreciation, we would take the $10,000 asset cost minus any salvage value, in this case there is none, and divide that depreciable cost by life, which is 5 years in this case. So we get $2,000 per year. The only thing you have to be careful of here is that you have to remember however life is expressed is how the result will come out. So in this case, life was expressed in years, so this is depreciation per year. If instead useful life had been expressed in months, if we would have divided 10,000 by the months of life, 60 months in this case, then we would have gotten depreciation per month, not per year. We record that depreciation in a depreciation expense account and an accumulated depreciation account. You saw that from the list of adjusting entries in Exhibit 9 of your textbook. So what I want to talk to you about is what accumulated depreciation is. Well, first of all, it's a contra asset. Contra means that it increases on the opposite side. So that means that accumulated depreciation increases on its credit side, because assets normally increase on their debit side. So this is a contra asset. It increases on its credit side. A contra asset is not a liability. It's still an asset. And if you think about the title, accumulated depreciation, and you think about what those words mean, accumulated means to accumulate or to build upon or to add up. So this account is allowing the depreciation to build up or add up. And there's a formula in your textbook in the fixed asset section that you do need to memorize. The formula is cost minus accumulated depreciation equals book value. When you're creating a balance sheet now, you will have to show the cost, the accumulated depreciation, and the book value.